So then I sort of, when I was talking to Keith, Keith said, could you do a bit of gross margin work on what we're looking at for next year? And so we started to think, okay, well, if we're assuming a return to something near normal growing conditions, we projected out what we think is about a decile 4 year, which is around about an average across the state of about 1.6 tonnes. We think if we got decile 4, we'd go 1.6. Wheat on Wednesday, ASX WA wheat was trading at $311 a tonne trackside. Looking at the global grains complex going forward, that while there's still a fair bit of wheat around today, it's really there's a lot of the other grains, certainly corn is at very low levels, oilseeds are looking good. We think wheat's going to lose the battle for acres next year, and so we're going to see prices stay up. I'm a banker, I'm fairly conservative, I'm going to say I'm looking at this stage at about $300 a tonne. I think there's upside above that, but that's where my projections are at the moment. So we're actually looking at wheat being quite positive and staying up at similar levels to this year, which would be great. And then we're looking at lamb staying over $100 a head as well. Hopefully a lot higher, but there's going to be a lot less numbers of sheep out there. So then when I look to my input costs, I just ran through them. There's going to be a lot less fertiliser go out there, but there's also going to be a lot more total grains planted, and so we're thinking that fertiliser costs are going to be a lot higher, and so fertiliser costs will be a lot higher even though the inputs will be down. So overall maybe down a little bit. Chemicals, there's still a fair bit left on farm, but costs are going to stay up there. R&M, we had a bit of an argument about this at work and sort of thought, well, maybe we'll see R&M because machinery wasn't working quite as hard this year. We might see some R&M down a little bit this year on last year, but that's maybe just wishful thinking. And then fuel's probably going to start either be stable or going up. But fuel is going to be offset by an Aussie, which if the Aussie goes down, then our export prices for grain goes up. So that gets offset. So then I put it all together, and we think that our view at the moment is that farm operating costs, they may go down, but if they go down, history says that they should go down a long way coming out of a drought. And what we've seen in the past is after multiple years of drought, they tend to come right off. But statewide, we're not expecting to see operating costs come down that much. Now, there's a lot of, you could put an argument, and certainly I think there will be some farms that really tighten up, but history says it won't happen, which is not great. So then, and you see I've put my very early estimates, that's my version of a disclaimer. I've assumed income of $413 a hectare, based on 1.6 tonnes per hectare, $300 a tonne for grain and $100 a head for lamb. I've put in expenses coming off a little bit, and I look at that and I go, it's fairly aggressive, but I don't see anything to argue that we'll see expenses come down. So that gives us $131 per hectare of operating profit, which would be above the long-term average operating profit per hectare. But the reason I'm sitting at that reasonably high operating profit per hectare is because I've kept my sheep prices are way up, and my grain price is above average as well. So if we get a farm operating, and then I've converted it out over an average farm, 4,100 hectares, which gives me $537,000 of operating profit. I've just gone in and said, okay, well, you've got to keep the machinery up to date, so I've allocated a machinery allocation, and I've just set $120,000 on drawings, which $120,000 seems a lot, but it's not. And it's that's not unrealistic. I've then gone in and I've made some assumptions around debt, assuming 70% equity and a fair bit of overdraft, and I've done my debt at 9% interest costs. And that leaves me with a surplus. Surplus of $63,000, which sort of surprised me, thinking that, you know, I was just playing with numbers when I put it together, but it was a little bit surprising to see that we actually came out with a surplus. And I think the positive really is saying, assuming grain prices stay higher, which it really is now, it's a game of grain, assuming grain prices can stay up, then 2011 could be the start of a recovery year for us, which is hopefully coming in there. When I look beyond 2011, I think the reality is that a lot of farms, in terms of their debt they're carrying, have really gone too far, and they might need some time, but unfortunately they're now carrying too much debt and they're not going to make it back. And so we'll need to see them, they will need to exit the industry. The issue we've got is that a lot of their neighbours who are buying them out are also in trouble as well, and so the ability to actually fund the purchase, where the capital is coming from, it's hard to work out exactly where that is. Clearly we need to see a bit of deleveraging of debt, because debt is really a function of risk, and as you're running at the debt levels we're running at the moment, we're seeing that we've taken on a huge level of risk, and it didn't pay off this year. And then grain prices have to stay up. So, just in conclusion, you know, losses in the order of $400,000 to $500,000. I have seen some initial projected budgets with losses in excess of $1 million, but not many of them. And I've seen break-even budgets as well. But $400,000 to $500,000, it's a good assumption to work on. We're starting with really low equity going into 2011, but looking into 2011, we think the prices look good, and if we can control our input costs, which I think is the real challenge, then we can actually look at profits coming out of 2011. And on that, I think I'll finish up.